Sysco Corporation, ticker SYY on the NYSE. Founded in 1969 in Houston, Texas, when John Baugh merged 9 regional food distributors into a single national company, Sysco has spent 56 years building the dominant position in U.S. food service distribution.
Today, Sysco distributes food to 700,000 restaurants, hospitals, schools, and hotels from 340 temperature-controlled distribution centers. It holds approximately 17% of the U.S. food service market, nearly double the share of its nearest competitor.
The company went public in 1970 with $115 million in revenue. By 1988, it had passed $5 billion. By 2000, it exceeded $20 billion, the undisputed largest food service distributor in the U.S. A 2015 attempt to merge with U.S. Foods was blocked by the FTC on antitrust grounds.
Kevin Hourican became president and CEO in 2020, a Cornell Hotel Administration graduate who spent 25 years at CVS Health, most recently as president of CVS Pharmacy, before joining Sysco at the height of the COVID restaurant shutdown crisis.
Revenue splits across 3 segments: U.S. food service operations at 74%, international food service at 16%, covering Europe and Canada, and Sigma at 10%, serving large chain restaurant accounts. Total revenue is $78.5 billion.
Gross margin runs at 18.8%. Adjusted EBITDA margin is 6.8%. In a distribution business that processes nearly $80 billion in volume, that margin generates significant free cash. Sysco has raised its dividend for 54 consecutive years, a dividend aristocrat.
The Sysco brand product line is the private label engine. Over 13,000 proprietary SKUs carry 40 to 50% gross margins versus 20 to 30% on branded goods. Every percentage point of menu penetration with Sysco brand directly improves the economics of that customer relationship.
Customer stickiness is structural. The average Sysco restaurant relationship lasts 15+ years. Food distributors are embedded in kitchen operations, ordering systems, and chef workflows. Switching costs run high because chefs do not want to risk supply chain disruption during a dinner service.
On the competitive radar, Sysco scores 98 on distribution scale and 95 on market share, both the highest of any peer by a significant margin. U.S. Foods and Performance Food Group are the 2 main national competitors, but each carries less than half Sysco's network density.
The international platform in Europe, UK, Ireland, France, Belgium, and Sweden, gives Sysco exposure to higher-margin markets, where the U.S. food service consolidation model is at an earlier stage. International food service revenue now exceeds $12 billion annually.
Sysco's 13,000-plus delivery vehicles cover virtually all of the continental United States daily. Building 340 temperature-controlled distribution centers with the accompanying fleet and management infrastructure took 56 years. The cold chain barrier to entry is $20 billion+.
Hourican has focused on 3 strategic pillars since joining: winning with independent restaurants, growing Sysco brand penetration, and expanding the international platform. Each pillar targets a specific margin expansion lever that the existing distribution infrastructure already supports.
Sysco processes $78 billion in food orders and touches almost every restaurant in America. The scale is so vast that the FTC blocked their last merger attempt because they were already too dominant.
The Jetro acquisition controversy is the short-term catalyst. If the price paid proves justified by cross-sell synergies with independent restaurant customers, the 54-year dividend streak just got another year of fuel. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive. Sysco Corporation, ticker SYY. Fiscal third quarter 2026 results are in, and the headline is deceptively straightforward. Another beat on adjusted earnings, gross margins expanding for the 4th consecutive quarter, and the Sysco brand private label penetration rate grinding higher. The business is executing. The stock has not caught up yet.
Sysco traces its roots to 1969 Houston, Texas. Today, a $34 billion food distribution colossus that processes nearly $81 billion annually, touching 700,000 restaurants, hospitals, schools, and hotels across the United States and Europe. When Sysco reports earnings, it is also reporting on the health of the American restaurant industry.
Adjusted EPS came in at $1.28 against the $1.18 consensus estimate, an 8.5% beat. Year-over-year, adjusted EPS grew 5.8% from $1.21 in fiscal Q3 2025. Sysco has beaten adjusted earnings estimates in 11 of the last 12 quarters. That is not luck.
Revenue, $20.25 billion, against the $19.8 billion consensus, a 2.3% beat. Year-over-year revenue growth of 3.5% from $19.56 billion in the prior year quarter. Modest by Sysco's historical 5 to 7% growth pace, but adequate in a challenging restaurant traffic environment.
The stock sits at $68 with an analyst consensus price target of $82.50, 21% upside implied. 12 buy ratings, 7 holds, 1 sell across 20 analysts. At 13.1 times forward earnings, Sysco is trading at a meaningful discount to its 18 times historical average. Something is priced in that may not materialize.
Let us walk through the GAAP income statement. Revenue, $20.25 billion. Cost of goods sold, $16.4 billion, leaving a gross profit of $3.85 billion at a 19% gross margin. That margin improved 20 basis points from 18.8% a year ago, 4 quarters in a row of expansion.
Selling, general, and administrative expenses of $3.05 billion. GAAP operating income, $800 million, a GAAP operating margin of 3.95%. Below the surface, adjusted operating income comes in near $1 billion after adding back amortization of acquisition intangibles and Jetro-related integration charges.
GAAP net income, $490 million. GAAP earnings per share of 97 cents. Adjusted EPS of 128 removes approximately $200 million of pre-tax non-cash amortization and acquisition costs that do not represent ongoing operating economics. As Jetro integration charges roll off through FY 2027, the gap to adjusted GAAP compresses.
The gross margin expansion is the most consequential data point in this report. 19% sounds modest until you remember scale. 20 basis points of improvement on $81 billion in annualized revenue equals $160 million of incremental gross profit per year. And Sysco is not done expanding.
The mechanism. Sysco brand private label now represents 38% of U.S. case volume. Sysco brand products carry gross margins of 40 to 50% versus 20 to 30% for national branded equivalents. Every percentage point of Sysco brand penetration adds approximately 15 basis points to consolidated gross margins. At 38%, there is runway to 40 and beyond.
Segment breakdown for Q3 FY 2026. U.S. food service operations, the domestic core, represents 74% of revenue and the majority of operating profit. International food service, UK, Ireland, France, Belgium, and Sweden, accounts for 16%. SYGMA, Sysco's chain restaurant supply division, is the remaining 10%.
U.S. food service delivered approximately 2% case volume growth year over year, with local and regional restaurant customers outpacing national chain accounts. That mix is favorable. Local and regional customers purchase more Sysco brand products, require more value-added services, and generate higher margins per case than the large chain accounts.
International food service revenue grew 5.2% year over year in constant currency. European operations continuing to build toward the private label model that proved successful domestically. UK and Ireland Sysco brand penetration is tracking above management's initial targets for this stage of the rollout.
SYGMA, serving national fast food and fast casual chains, faced headwinds as quick service restaurant traffic softened in early 2026. Consumer spending pressure at the value end of the restaurant market is real. SYGMA is Sysco's most volume-sensitive segment. When fast food traffic slows, SYGMA cases delivered decline proportionally.
Interest expense of $175 million reflects the post-Jetro debt structure. Other income of $20 million. Pre-tax income on a GAAP basis was $645 million. Tax expense of $155 million at an effective rate of 24%. Final GAAP net income, $490 million.
Balance sheet snapshot at quarter end. Cash on hand, $700 million. Total debt 14.3 billion, 1 billion short-term and 13.3 billion long-term. Net debt of 13.6 billion reflects the leverage taken on to complete the Jetro Restaurant Depot acquisition, which added approximately 2.5 billion to the debt structure.
Net debt to adjusted EBITDA of 2.7 times. This sits within management's stated target range of 2.5 to 3 times, but it is elevated relative to Sysco's pre-Jetro operating history. The path to deleveraging: generate free cash flow, direct it to debt repayment, and allow Jetro EBITDA contribution to grow the denominator.
Operating cash flow was negative 250 million this quarter, a well-established seasonal pattern. Q1 of calendar year is when Sysco builds working capital ahead of the spring-summer food service peak. Inventory and receivables expand before revenue accelerates in spring and summer. Trailing 12-month operating cash flow, approximately 2.5 billion.
Capital expenditure of 250 million per quarter, 1 billion annualized, funds ongoing distribution center expansion, cold chain technology upgrades, and fleet replacement. Trailing 12-month free cash flow of approximately 1.5 billion represents a 4.3% yield on the 34 billion market cap. The cash generation is real, even if Q1 looks soft.
After dividends of approximately 1 billion annually and 75 million in buybacks this quarter, Sysco generates roughly 300 to 400 million per year of residual free cash flow currently directed toward debt reduction. Management is deliberately prioritizing leverage reduction over share repurchases, a signal of balance sheet discipline over short-term EPS accretion.
Current ratio of 1.2 times, adequate for a distribution business with predictable receivables. Total assets 22 billion, total equity approximately 3 billion. The low equity base reflects decades of share repurchases and goodwill from acquisitions, not operational weakness. The earning power and cash generation are structurally strong.
Dividend of 51 cents per quarter, $2.04 annualized, yielding 3% at $68. Payout ratio on adjusted EPS of 39%, well below the 60% threshold management treats as the upper bound of dividend safety. The dividend is secure and growing.
Forward guidance. Sysco reaffirmed full fiscal year 2026 targets. Adjusted EPS of 5.15 to 5.25, revenue of 80.5 to 82 billion. The midpoint of 5.20 represents 9% adjusted EPS growth over FY 2025, actual of 4.78, despite the headwind from soft restaurant traffic trends early in the year.
The forward EPS projection implies meaningful back half acceleration. Fiscal Q4, April through June 2026, carries a consensus estimate of 142 per share, up from the 128 just reported. The ramp reflects seasonal volume peaks in spring dining, continued Sysco brand penetration growth, and waning Jetro-related integration charges.
Fiscal year 2026 revenue of 81 billion builds on FY 2025, 78.5 billion with 3.2% growth. Below the historical 5 to 7% growth algorithm, management is guiding conservatively given the uncertainty around restaurant traffic recovery. A beat on the revenue line is more likely than a miss given the cautious setup.
Long-term earnings growth algorithm, 7% annual adjusted EPS growth. The driver is gross margin expansion from Sysco brand mix, not volume acceleration. For a consumer defensive distribution business paying a 3% dividend and growing EPS at 7% per year, the 10% total annual return baseline is compelling at 13 times earnings.
The Jetro synergy contribution is the variable in the 3-year outlook. Management guided 150 million in pre-tax synergies by FY 2027 from cross-selling Sysco's technology, credit, and specialty sourcing services to Jetro's 30 pendant restaurant accounts. At 24% tax, that is 114 million incremental after-tax income, approximately 22 cents additional EPS.
Fiscal Q4 FY 2026 setup looks constructive. Warm weather historically drives restaurant volume, outdoor dining opens, catering season begins, and Sysco's local and regional restaurant customers, its highest margin accounts, increase ordering frequency. The 142 Q4 consensus has upside if spring-summer dining activity normalizes from early year softness.
Fiscal 2027 EPS consensus sits at approximately 580 to 610, 11 to 17% growth over FY 2026 estimates. At $68, that is 11 to 12 times FY 2027 earnings. If the Jetro synergy timeline holds and Sysco brand crosses 40%, the forward multiple is among the cheapest in consumer defensive.
Options positioning reflects cautious optimism. Unusual call activity in the June 72 calls, approximately 1,500 contracts, positions for continued momentum following the earnings beat. The strike implies $7 upside over the next 60 days. Put-call ratio of 0.65 leans modestly bullish.
On the put side, 800 May 65 contracts represent downside hedging against restaurant traffic data that could disappoint. The May expiry suggests traders are concerned specifically about the next monthly restaurant sales report, the industry indicator that most directly validates or undermines Sysco's volume assumptions.
Implied volatility at 22%, modestly above the historical 15 to 18% range for a consumer defensive distributor. The options market is pricing incremental uncertainty without pricing fear. No unusual block trades or large institutional positioning that would signal a major directional bet in either direction.
Insider activity, neutral. No open market purchases or sales disclosed post-earnings. CEO Kevin Hourican retained shares from recently exercised options. No profit-taking after the beat signal. Institutional ownership at 85%, with Vanguard at 10.2% and BlackRock at 7.8%. The shareholder base is stable and predominantly long-oriented.
Valuation context. Forward PE of 13.1 times at $68 against an 18 times historical average. That discount represents 27% of compressed multiple. Stated differently, Sysco historically traded above $85 on the same earnings trajectory it is delivering today. The market is applying a temporary discount for knowable risks.
EV to EBITDA of 8.0 times. Enterprise value approximately $49 billion against trailing adjusted EBITDA of roughly $5.3 billion. For a business with 17% market share, durable customer relationships averaging 15-plus years, and 54 years of consecutive dividend growth, 8 times EBITDA suggests meaningful undervaluation.
Price to sales of 0.43, the lowest decade reading for SYY. Price to book of 2.5 times. This combination of sub-half revenue multiple and below historical PE tells you the stock is priced for stagnation. But the earnings trajectory is not stagnating. Adjusted EPS grew 5.8% year over year, while the stock has essentially flatlined.
A simple re-rating scenario. If Sysco executes toward FY 2027 consensus of $6 per share and the multiple recovers to 15 times, still 3 turns below historical 18 times, the implied price is $90. From 68, that is 32% capital appreciation before dividends. The conservative scenario is compelling.
What keeps the multiple depressed? 2 identifiable risks. First, Jetro integration. Markets need synergy evidence before rewarding acquisition leverage. Second, restaurant traffic data that has been soft enough to justify conservative revenue guidance. Both are cyclical and time-limited rather than structural, which is why the margin expansion story is quietly building underneath them.
Now, let us look at Sysco alongside its rivals in the food distribution sector to calibrate whether the discount is warranted. U.S. Foods Holdings, ticker USFD, the second largest distributor at 11% U.S. market share, currently trading at a forward PE of 15.5 times. U.S. Foods is more expensive than Sysco despite lacking the scale advantage, private label economics, or dividend track record.
Performance Food Group, ticker PFGC, at 8% U.S. food service market share and a forward PE of 12.5 times. Cheaper than Sysco on earnings, but operating at 11.8% gross margins versus Sysco's 19%. Performance Food is a volume and price competitor without the Sysco brand margin engine. Cheaper for a reason.
Chef's Warehouse, ticker CHEF, the premium and specialty food distributor, serving fine dining and specialty restaurants at a forward PE of 20 times and gross margins of 24.5%. A premium valuation for a premium niche. Chef's Warehouse targets a different customer segment than Sysco's mass market food service model.
EV to EBITDA comparison. Sysco at 8 times, US Foods at 9.5, Performance Food at 7.5, Chef's Warehouse at 12. Sysco sits in the middle, appropriate given scale advantages offset by higher post-acquisition leverage. On a leverage-adjusted basis, Sysco's underlying business generates superior returns per dollar of capital employed.
Revenue comparison for context. Sysco at $80.5 billion is larger than US Foods at $37 billion and Performance Food at $62 billion combined. Scale at this level creates procurement advantages, route density, technology investment capacity, and cold chain infrastructure that competitors structurally cannot match, regardless of capital spending.
Gross margin differential is the competitive moat made quantitative. Sysco 19%, US Foods 17.5%, Performance Food 11.8%, Chef's Warehouse 24.5%. Sysco achieves near-premium distributor margins at commodity distribution scale. That is what Sysco brand private label has built over 50-plus years of penetration growth.
The peer conclusion: Sysco should command a valuation premium over USFD and PFGC based on scale, margin superiority, and dividend track record. It currently trades at a discount to USFD on forward PE. That inversion should correct as Jetro integration clarity emerges over the next 2 to 4 quarterly reporting periods.
Analyst Consensus, 20 analysts covering SYY, 12 buy ratings, 7 holds, 1 sell. Consensus price target 82.50 represents 21% upside from current levels. The target high is $95 from the most bullish analyst. The low is $70, essentially flat. The street is constructive, but patience is the thesis.
Bull case at $95 requires 3 catalysts converging. Sysco brand reaching 40% U.S. case volume by Q4 FY 2027, Jetro cross-sell synergies delivering the $150 million pre-tax target, and restaurant traffic recovering to 3 to 4% volume growth across the U.S. food service industry. All 3 are plausible. None is guaranteed.
Bear case at $70, essentially flat to current. Prices in prolonged restaurant traffic softness, Jetro integration slippage into FY 2028, and leverage staying above 2.75 times through FY 2027. At $70, you are paying 12 times forward earnings for one of the most durable distribution franchises in the world. That is a demanding pessimism.
Base case at $82.50 assumes Sysco brand reaches 39% by fiscal year end. Modest Jetro synergies begin appearing in Q2 FY 2027, and restaurant traffic grows 1 to 2%. This is the 17 times FY 2027 EPS scenario, a reasonable return to historical minus discount for leverage multiple that represents the consensus path.
The single leading indicator to track: Sysco brand case volume as a percentage of U.S. food service operations. When this number crosses 40%, consolidated gross margin likely crosses 19.5%. That inflection, combined with Jetro EBITDA contribution entering year 2, is the trigger for multiple re-expansion from 13 to 15-plus times.
Secondary metrics: net debt to EBITDA trajectory. Management's 2.5 times deleveraging target is the balance sheet milestone. Sigma volume trends as a real-time signal for chain restaurant health, and international food service margin progression as proof that the European private label replication is tracking the U.S. playbook.
Bottom line on Sysco Q3 FY 2026, adjusted EPS beat 8.5%, revenue beat 2.3%, gross margins expanded for the 4th consecutive quarter to 19%. The business is executing the private label margin thesis with discipline. The stock simply has not reflected the earnings progress.
At 13.1 times forward earnings with a 3% dividend yield and 7% long-term EPS growth, Sysco presents either as the most undervalued defensive distributor on the market, or as a stock the market has correctly priced for a prolonged restaurant traffic headwind that 4 consecutive EPS beats have not resolved.
The case for patience: restaurant traffic headwinds are cyclical and correlated with consumer confidence. They normalize. The Jetro cross-sell opportunity is real, and the timeline is measured in quarters, not decades. The Sysco brand thesis compounds quietly every quarter, regardless of macro conditions.
The case for caution: Leverage at 2.7 times constrains financial flexibility for 2 to 3 more years. If the restaurant traffic recovery does not materialize by late 2026, guidance risk increases and the earnings beat streak faces pressure. Know what you own and size accordingly.
If this analysis added value to your research process, subscribe to Charged Alpha for weekly earnings deep dives across the S&P 500. Drop your SYY thesis in the comments. Whether you are long, short, or on the sidelines, we read every response, and it shapes our coverage queue.
This content is for informational and entertainment purposes only and does not constitute financial advice. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. Charged Alpha is not a registered investment advisor.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.